Hi, welcome back to Bazaar Morning Call. Well, the market is open slightly cautious, so down about 0.2% on the Nifty, just consolidating after the big gains last week. But the mood has been dampened by weak earnings from the likes of ACC and good banks like Federal Bank. So those are stocks that are under pressure this morning, 3% and about 10% apiece, respectively, for ACC and Federal Bank. But this week is a special week for us because our team has traveled down south to the city of Bengaluru. And now we have joining us Bharat Iyer, Head of India Equity Research at JPMorgan. No, he's not a Bengaluru boy, but he does know a lot about the Bengaluru markets and has been watching it closely. Bharat, hi, good morning, and thank you for joining us. First, a bit about, what the market setup is looking like, because so far the going has been good, but now reality hits us, with the weakness in earnings, etc. How are you wading through all of this?
Well, I think earnings, are a near-term distortion as far as the markets are concerned. But Sonia, you will appreciate that, earnings estimates have been coming down for 12 or 14 months. And that's really not been a dampener for the markets. The markets have held their own, they've done well. And as we see it, the market's basically been driven by two factors. One is from a local perspective, progress on reforms, and two, from a global perspective, global risk appetite. So I think as long as these two stay supportive, I think, no one really needs to worry about the markets. Coming to earnings specifically, our own call is that, perhaps have another couple of quarters of weakness. But going into the second half, I think we should see things pick up.
Okay, so you said progress on reforms, and that's interesting because the monsoon session of the parliament kickstarts tomorrow.
Yes.
I don't know whether there are too many expectations because there is a lot of work being done outside parliament as well. But what is your own view?
Well, I think the government, in terms of, the job they've done so far, I think that's been fairly positive. We've seen meaningful improvement in governance and the kind of clearances they've given out. We saw both the telecom and the coal auctions go off without any hitches, and they got very good money for it. If anything, the private sector complained that they had to pay a lot. We've seen FDI limits in defense and insurance being increased. Yes, we have to concede that, they have a binding constraint in terms of not having the numbers in the upper house of parliament. And reforms that require legislative reform will need consensus building.
Okay. Hi, Bharat. I regret not having you with me in Bengaluru. Bengaluru is a Kannada city, but it's got a fairly large Tam minority as well. Well, in any case, Bharat, I heard you speak about global liquidity. In the last, 2-3 weeks, we've got some positive FII flows. There appears to be a short crude, long India trade playing out.
Yeah.
Has that trade got more legs?
I believe so, Lata, because I think, it was not just the short crude long India trade. I think it was a combination of factors. We saw global risk appetite in general cool off a bit on the back of events in Greece and China. And what we've seen is, there's been a fair bit of relief in those two places as well. So I think it's a combination of factors. Greece and China have settled down. Crude has come off. And we're also seeing, locally the monsoon is a little better than expectations. So I guess it's a combination of reasons. And what we're seeing is more of a relief rally in that sense.
Okay. Well, let me read a bit of your note. I'm given to understand, this is a paraphrasing of your note, not verbatim, that at a sector level, capital goods, telecom, utilities and consumer staples are expected to see relatively healthy earnings growth. I have some worries about a couple of those sectors. Consumer staples.
Yeah.
Is really urban demand picking up enough to counter rural growth? We understand that rural demand has been still quite bad.
No, I agree with you, Lata. I think urban demand has bottomed out decisively and is showing some signs of picking up. But by itself, is it enough to, offset the weakness in rural demand? Not necessarily, not at this point in time, which is the reason the preferences for picks or companies, are more geared towards urban demand rather than rural demand.
All right. And utilities, sir. That also kind of had me wondering, you would have to be very picky, isn't it, in utilities?
Absolutely, Lata. I think, the preference will have to be for the central government utilities, as well as a couple of the private sector utilities, which even in the last quarter, you would have noticed, had a very good free cash flow operating environment. So you have to be picky. Absolutely right on that.
Okay. Capital goods again. Actually, some smaller companies for which we don't seem to get analysts, like FAG Bearings did very well. There appears to be some kind of replacement demand, at least if not fresh demand. Capital goods, what would be the pick of the pack? How should an investor go discerningly about this pack? Because capex at least has not taken off.
Well, as far as the capex cycle is concerned, I think, one has to view it from the prism of the fact that private sector capex is not going to pick up in a hurry. I mean, the private sector has constraints. I mean, they see a very iffy global environment. Leverage is very, very high there. So I guess the onus is largely on the government. And from the government's perspective, it appears, that they're focusing on three areas really: roads, railway, and defense. So I think companies that are, geared towards these opportunities, I think should be very good to pick on.
All right, well, just watch out for the markets, because now the Nifty is falling some more. It's not a big sell-off or anything. It's just some positions being taken off. So 85.74 on the Nifty, a cut of little less than 0.5%. And the Bank Nifty is underperforming. It's down more than 0.5%. So Bharat, for the rest of the year, what kind of a performance do you expect to see from the index? Are there any more gains that one can expect, or do you think the best of the news is already in the price?
Well, Sonia, what we really like about the markets at this stage is that, they've consolidated for the first 6 or 7 months of the year. And, there was a very meaningful discord between reality and expectations at the beginning of the year. Yes. And that discord is actually, is meeting up right now. Expectations have come down meaningfully. In terms of the prognosis for the year, I think, our base case still is that, there is about 10 to 12% to be had in terms of broad market returns through to the end of the year, largely driven by earnings growth. Because let's appreciate it, valuations at about 17 times forward earnings leave very little scope for re-rating. So earnings will have to do the heavy lifting. We believe that, we should end this year with about 10 to 12% of earnings growth, and that's where we're expecting the market returns to come in from.
So an additional 10 to 12%?
Yes, an additional 10 to 12% through to the end of the fiscal year, yes.
All right. Going through your report, another space that you like is cement. Yes. And you're not alone. I mean, there is a large population that is hopeful of a recovery in the cement sector, but that has not played through just yet. You can see it in ACC's numbers. Yeah. Would you still be bullish?
I would still be bullish because, the call on cement is predicated on two things really. One is, a meaningful cyclical pickup going into the second half, particularly as, the government's efforts to, kick up road construction take off. I think that can be a very meaningful demand stimulant. And also, we must appreciate that setting up capacity is going to be a problem now. So, utilization levels can trend up very, very meaningfully, and with no capacity coming up, I think, that should be very, very positive for pricing. And the third driver for cement could be very low input costs. We've seen a very meaningful reduction in coal costs.
Okay. Well, Bharat, I want to refer to one of your rivals' reports. Credit Suisse has written a fairly hard-hitting report on steel, saying that, capacities will just have to be closed down for some others to survive. The more difficult ones will have to be closed down. Only then, at least the older hands or the stronger hands will survive. Now, I'm not worried about the steel sector. I don't think any of you have or have recommended positions or investment ideas in that space in some time. But what about banks? Private sector banks were the darlings of a lot of investors. Surely they also have to shed a little weight, you think, because of these kinds of troubled assets?
Well, Lata, I appreciate the point. We're in the same boat more or less. I think, the steel sector is in a fairly bad spot. And it doesn't help that global demand is weak, and, our currency issues don't help the steel sector locally as well. But that said, I guess, a bulk of the problem is really located in the state-owned banks. The private sector banks largely have limited exposure to this space, which is the reason, our preference continues for the private sector banks over the state-owned banks, because, they seem to be improving in terms of the capital and liability franchise. And as far as loan growth is concerned, they can afford to be very, very picky in an environment like this.
No, it's axiomatic that they have managed their books better. Even if you take for the sector as a whole, I think their bad loans is gross NPLs is 3.5%. Public sector banks is 5.2%. That is axiomatic, almost a tautology. But are they not priced to perfection? As new problems come in, $20 fall in landed steel prices in a week because of the Chinese issues. Therefore, can you still make money in private sector banks?
I think so, Lata, because, let's also appreciate that, one, the public sector banks have a higher exposure to the steel sector as compared to the private sector. And, I think the market's been a little bit discerning even in the case of the private sector banks. What we've seen in the last 6-7 months is that private sector banks, which have a larger exposure to, say, infrastructure or the metals and mining sector, have not performed as well as the private sector banks, which have a lower exposure. So the market has been discerning in that sense.
Okay. All right. Let me come to my favorite macro theme, interest rates. The way crude is trending, what are you all giving by way of space for rate cuts or at least rate falls in the market? And therefore, what would be your sector themes?
Well, Lata, as far as the rate cut environment is concerned, the call right now is, there's very limited scope until at least the monsoon is out of the way. Because, given the guidance given that the RBI expects inflation at 6% by January, and also the guidance on, wanting risk-free real interest rates of 1.5%, I think it's going to be very difficult over the near term. But, touch wood, if the monsoon is out of the way and it pans out okay, and, if, say, Brent settles down at, say, around the $50 mark, then perhaps, you do have scope for one rate cut, perhaps sometime late in the last quarter of the financial year.
Yeah. Okay, so would you tank up on NBFCs, real estate companies, those who benefit from lower interest rates?
Not necessarily, not at this point, Lata. I think it's too early in the cycle to do that. I think the preference even now remains for high-quality financials with a very strong capital and liability franchise. I think, the wholesale funded entities or those banks, which need to grow their way out of trouble, I think it's very early in the cycle to start going after them. I mean, they typically tend to be late cycle plays.
All right, and finally, let me come to automobiles. Whether you are a Bengaluru boy or not, you are definitely an automobile boy. That was your first sector of choice, yes, wasn't it, in your previous avatars? What in that space do you like?
Well, as far as the auto sector is concerned, I mean, if I could really divide it into three parts, two-wheelers and tractors, cars and commercial vehicles. I think, we are underweight the two-wheelers and the tractors. We think that the rural discretionary consumption cycle is seeing serious cyclical pressures, and that could carry on for another year or two. We'd be more positive on the passenger car segment, which is geared towards the urban demand, as far as commercial vehicles, which is geared towards investment demand. So the preference clearly is for four-wheelers, both cars and commercial vehicles, in relation to two-wheelers and tractors.
But most of these four-wheeler makers, whether it's Maruti or even, some of these luxury two-wheeler makers like Eicher Motors, etc., are sitting at record highs. So would you still back these names despite the stratospheric valuation?
Well, I think, Sonia, the theme going forward is going to be, visibility and sustainability of earnings growth. And as far as the names you mentioned are concerned, they have both of those. Whereas, what I suspect will happen is for the two-wheelers and tractors, we still need to see earnings come down. I think there will be cuts. So, the market will continue to bid up names where there is visibility and sustainability.
Okay. Let me talk about, some of the big numbers that are expected this week. There's HUL from the FMCG space. And in FMCG, we've actually seen a slowdown, a grind down in demand, stunted single-digit growth for many of these players. Is that something that you will continue to see in the quarters to come?
I think so. I think, even FMCG will perhaps see muted demand for another 2 to 3 quarters at least. But that said, in terms of making relative preferences, I think we'd be more positive staples as compared to the consumer discretionary pack. Because, one must appreciate that as far as the staples are concerned, they're seeing a lot of raw material deflation. Because typically their raw materials tend to be either petroleum derivatives or food derivatives. And so I guess, they have that much more leeway in terms of, margins or in terms of pricing, which unfortunately the discretionary pack does not have. So on relative terms, we'd still prefer the staples to the discretionary. But in absolute terms, I mean, will they both feel the pinch? Yes.
Okay. Finally, as we wrap up our conversation on the sectors, you remain overweight on the IT services space. And that one has come back into action in the last couple of weeks. But we've seen unimpressive numbers from the likes of TCS, etc. Is that fine, or is that something that would bother you in the quarters to come?
No, not necessarily. See, I think, Sonia, when we talk to investors, I think the big concern expressed is, are we going to see a very serious slowdown in growth on a medium to long-term basis? Our thesis there is, yes, I mean, growth has trended down. What was 25% is, perhaps going to be 8 to 10% for the next 2 or 3 years. But, I think, the better managed companies will take market share. They will have some leverage benefits and add to it 3 to 4% rupee depreciation every year. And I still think, there's a very, very reasonable investment case there. Add to it that, I think most of the smarter companies will look for the next driver of growth, the next engine of growth. And, they will focus on, what are buzzwords today, digitization, artificial intelligence, cloud, etc. And if they can make it in those arenas, then, there's no reason why they can't grow at 15 to 20%. So, broad scenario, I think the sector still grows at 8 to 10%. Those who can do well can still grow at 15 to 20%. So, we remain positive.
So you don't think it will be hard for these companies to catch up on the digital wave and...
See, it's going to be more selective. Unlike the plain vanilla services businesses, where, anyone and everyone could make it, I mean, as long as, they had the basic skill sets, this is going to be that much more challenging, which is the reason you'll have to be a little more picky than you were in the past.
All right. Before we let you go, Bharat, you were telling us about how you expected 10 to 12% growth in the markets, say by the end of this year. So have you do you believe that now the global worries are completely out of the way? Because now come September, we'll start talking about the Fed lift-off as well, its impact on emerging markets. How much credence would you give global worries now?
Well, Sonia, those are the two biggest risks for me for the Indian equity markets. I don't see too many internal risks, but the external risks are really, if oil stages a V-shaped recovery, or, if at some point in time global central banks realize that they are running behind the curve on inflation and have to tighten faster than expected. I mean, those concerns remain. We hope that they don't play out, but we have to be vigilant and watchful for those.
All right, on that note, we'll thank you.